Hi, I'm Lucila Bonilla, Global EM Economist at Oxford Economics. If I were to summarize the latest EM macro developments, I'd say they've been encouraging. EM resilience has impressed and stagflation fears have eased. We've seen some reassuring signs on the inflation front as our prices and risks decline sharply across regions. This has boosted our confidence in our below consensus forecasts as we expect global activity to slow over the next couple of quarters and global food prices to decline through 2024. Persistence risks remain, but they seem less acute than 6 months ago. At the same time, a stronger than expected consumer-led growth lifted our GDP forecasts across the board. Our EM activity trackers show that from an aggregate point of view, growth has been very resilient in H1. Preliminary May nowcasts suggest an average 3.3 yearly growth in EM excluding China. We find several reasons for cautious optimism. We've repeatedly stressed that EM central banks did their homework and got ahead of the curve, probably because their young inflation targeting regimes could not afford to see through the supply shock and risk expectations becoming unanchored. Our recent survey shows that EM monetary policy frameworks remain robust and central bank credibility is intact. Improved sentiment towards EMs and lower global volatility should attract portfolio flows, further benefiting exchange rates. Big US yields, a relatively weaker dollar, robust credibility, and disinflation should all help EM central banks cut ahead of the Fed. We expect growth to be weaker in 2024 as our baseline assumes that domestic demand will need to be sluggish for some time if inflation is to fall back to pre-pandemic levels, mainly in parts of Latin America and Central and Eastern Europe. But downside risks still linger. An extended Fed tightening cycle could hurt global demand. A stronger for longer dollar or a sustained period of EM demand overheating could lead to prolonged above target inflation. So, how does the outlook translate into our EM asset allocation? Local currency debt remains our preferred global asset class as disinflation picks up and FX remains strong. We still find valuations attractive, but as the rally gains track, they will compress. From a cross-country perspective, this month we downgraded low-yielding emerging Asian countries, and further tilted our portfolio to Latin America and Central and Eastern Europe. Thanks for listening, and do reach out for more of our EM analysis and insights.